You're literally just buying someone else's savings. You're not actually spending for future production. The idea of investing, I think, sometimes is viewed as something sexy or like a get-rich-quick kind of endeavor, but it should be a long-term, thoughtful process that is much more akin to reallocating your savings than sort of a get-rich-quick investing endeavor that a lot of people might think of it as.
Thank you for joining us for part 2. Welcome back.
Hey, Paula. Great to be back.
I want to talk to you about your 10 principles because these are, what we've talked about. So for most of this conversation has been tactical. It's been here are a couple of here's a variety of different model portfolios and sort of embedded within how to choose. You've touched on some principles, but I want to make those principles more salient.
Mm-hmm.
So let's actually talk through the 10 principles that you have outlined, starting with principle number 1, which is that you're a saver, not an investor.
Yeah, so this is something that I kind of battled with. I wrote a different book called Pragmatic Capitalism 10 years ago, and that book was a finance book and an economics book. And so I talk a lot about the principles of economics in that book. And something that I struggled with in that book is that the word investing has totally different meanings in the field of finance and in the field of economics. And in the field of economics, it means to spend for future production. Mm-hmm. And that's done by firms or individuals when when you're building your human capital, your skill set, you might spend money to go to school. That you're making an investment in your future production. And firms do this. We describe investment in economics as, spending for future production. And that might be something like, building a factory or something. And the firm is actually allocating capital into something that is going to generate a return on investment in the future. And the weird thing about what we do in finance is that, I talk about how you're allocating your savings. When you actually go out and you buy stocks and bonds on, the stock exchange or whatever, you're not actually spending for future production. You're not even financing the firm's ability to do that necessarily. And you're literally just buying someone else's savings. You're buying a stock, the person selling the stock is buying your cash, and the firm actually isn't even involved in any of this. They don't care what's going on with your secondary market purchases because you're literally just reallocating your savings. And so the reason I like this concept is because from an application perspective, the idea of investing, I think sometimes it's sort of viewed as something sexy or like a get-rich-quick kind of endeavor, mm-hmm. whereas allocating your savings is fundamentally boring. It's a prudent process. It's a long-term process. And so I try to communicate that concept to people, not to, be a dork about the jargon in the industry, but because from a very sort of fundamental perspective, you are reallocating your savings, and you should go into the process of building a portfolio with that sort of mentality that, hey, this is a process that, sure, I can make a lot of money doing this, but it should be a long-term, thoughtful process that is much more akin to reallocating your savings than sort of a get-rich-quick investing endeavor that a lot of people might think of it as.
Right. Would it also be accurate to say that, if a person really wanted to get wealthy, you would need direct involvement in a business that you yourself own and operate?
Yeah, and that's the other thing is that that's true investment. If you really, again, running a business is really risky. Mm-hmm. The vast majority of businesses over a 10 or 20 year period are going to fail. Mm-hmm. And so investment, actually spending for future production at like a firm level, it can be really risky. And so it's a fundamentally like very different thing than just reallocating savings into a diversified index fund or something. And so, it's also a highly specialized and different way of allocating capital, because typically when people are starting a company or something like that, or investing in their own human capital, they have a specialty in that. Like you're a great communicator. So you're very good at allocating capital into your business because you're such a great communicator. And that's a skill set that you've developed over a long time. And you have a unique ability to take advantage of that a lot of people probably don't. And so in a way, you're taking a high risk, but you're taking a very specialized sort of risk in something that you have a unique skill set in. And so running a business is typically something that is an allocation of capital that's, although it's risky, it is built on your skill set and your specialized human capital that you're then trying to leverage into something greater or more valuable in the long run. But it also is, as you mentioned, it's the primary way that people get rich, whether it's, just becoming a lawyer or a doctor or being an entrepreneur who runs their own business. I mean, typically the doctors will get rich also, but they may not get as rich as the business owners of the world, because maybe, they're just not taking quite as much risk. They're still taking risk, but they're maybe not taking as much risk as the entrepreneur. So it's a very fundamentally different thing.
All right, let's talk about principle number 2. You are your portfolio's worst enemy.
Yeah, and this kind of goes into the behavioral component of all of this, that you're the person who is constantly going to second guess the way you've allocated your savings. And you're going to be the person who, when you go through the big bear markets and the big bull markets, you're going to constantly question, what am I doing here? I see the grass seems greener on the other side of the street. And, should I be more invested in AI? And, it's hard because we talk a lot about fear in bear markets, but the FOMO, the fear of missing out, is equally as potentially disastrous for a lot of investors, because it's the thing that leads to performance chasing and people feeling like, when you look at things like the huge outperformance of the US market or the huge outperformance of AI, you might look at that and you feel this FOMO where you say, God, I maybe don't own enough of this high return yielding stuff that maybe now I should chase it. And oftentimes people chase performance, and that ends up being one of the worst things people can do, because oftentimes you're chasing risk. You're not actually chasing return. And, so it's hard because you are going to consistently be your own worst enemy in this whole process. And I think you have to go into it knowing yourself and knowing the behavioral biases that are going to inevitably arise over the course of your investing lifetime, because you're going to constantly expose yourself to the risk that you intervene and you become your portfolio's own worst enemy.
Could you also have the opposite risk where you become negligent and fail to rebalance, fail to do anything that isn't automated?
Yeah, I mean, it's the reason why, I think a lot of people like to offload portfolio management to financial advisors, is because they feel like, oh, if I've got a second set of eyes on this, people are busy. If you've got a full-time job and whatnot, and you're focused full time on something else, it's really easy to let a portfolio get disorganized. Like I woke up one day, and this is crazy for a financial advisor, but I woke up one day, about 10 years ago, and I looked at all my different accounts, and I had, 401ks and IRAs at different custodians. And I looked at it and I said, this is crazy. Across me and my wife's accounts, we've got like 8 different custodians and 8 different accounts. And, we sat down one night and we were like, we've got to collapse all this down into like a more manageable, just simplified custodial process where we're looking at like 1 or 2 custodians maybe, and you're not having to log into like, Treasury Direct and Fidelity and your 401k account and your Schwab account and your bank account. It can all get super complex super fast, especially as, you get older and life gets more complex. And so you really easily become negligent of it, because it can so easily become disorganized. And it's one of the things I talk about a lot throughout the book, is that simplifying things and organizing things to make the management of it really simple is super important. And I'm actually, for a financial advisor, I'm actually a huge advocate of being a DIY investor. Like one of the best things that happens over the course of working with a client is when they come to me and they say, you know what, I really like you, Cullen, but I'm going to DIY this. And I'll oftentimes say to them, like, that's awesome. That means that like you're not incurring the fees that I charge. And if you're super comfortable and you know that this is something that you can DIY, that's amazing. But at the same time, I understand the psychosis behind people who hire financial advisors, because they look at people like us and they say, you know what, I need someone to help me navigate all of this, because I'm overwhelmed by my everyday life, and I can't feel like I have this burden of like a second job managing my money and understanding all the crazy stuff that's going on in the economy and the financial markets all the time.
Let's talk about principle number 3. Beating the market is hard.
Yeah. And this is the reason why I don't talk about stock picking a lot in the book, is because I try to emphasize the data that, I mean, over the course of a 20-year period, more than 95% of all active managers will underperform an index fund, which is a crazy, crazy stat. I mean, these are the smartest people in Wall Street, and they're going to inevitably, in the long run, they're going to underperform a simple index fund. And so I think you've got to go into this whole thing when you start to build your perfect portfolio. You've got to understand that, okay, if I'm trying to beat the market, if I'm trying to do something, really sort of sexy and, higher risk than the market or whatever it might be, you've got to go in knowing that this is a really hard game, and that this is why people like John Bogle were such big advocates, why Warren Buffett is such a big advocate of index funds, is because he knows the math behind all of this. And so, I try to emphasize that, you want to keep things simple, and you don't want to be too hands-on with stocks, because again, you might end up being your own worst enemy by trying to be so involved and trying to play this game where you're trying to beat the market, where you actually end up doing a lot of counterproductive things.
Is it reasonable to have a small, let's say 5% or less of your portfolio, or maybe 10% or less of your portfolio, small allocation towards the to individual stock picking? Like people refer to it as fun money.
Yeah. Yeah, totally. I describe it as like scratching that itch. I don't think there's anything wrong. In fact, I mean, with stock picking, the sort of like academic work behind it is basically that once you own more than 25 stocks, you're probably diversified enough in the stock market that you haven't eliminated single entity risk, but you're diversified enough that you probably own something that will look relatively close to like a diversified S&P 500 fund or something like that, especially if you've done it sort of methodically across different sectors and different styles. I'm not like militantly against stock picking, even though I didn't write a chapter about stock picking. I do like to emphasize that, the psychology of all of this is so important, that if that 5% piece is keeping you interested, and it's keeping you kind of, it's scratching that itch that's making the 95% piece sort of viable, then yeah, scratch that itch and have the 5% piece, because if that's the thing that's making the 95% viable in the long run, then that 5% component is actually maybe the most important piece of the whole puzzle.
What would you do then? Let's say that you've got that 5% piece and something wildly takes off. And so what started from on a cost basis point of view, what started as 5% has now grown to 20%.
Yeah.
Do you let it ride because you're playing with house money, or are you factoring that to a new?
Yeah, it's hard. It depends. If it's if it's in a taxable account, you kind of feel handcuffed. You got these golden handcuffs on, where you've got a huge taxable event. If you were to, because the good financial advisor would say, well, you've got to rebalance, reduce the single entity risk. Now you've got to, rebalance that component back down to roughly where, you wanted it to be, roughly where the 5% piece is. But there's also a really cool solution these days with 351 exchanges, and not to get like too wonky about this, but what a 351 exchange basically does is it allows an investor that's got an outsized allocation in, say, like a single stock. Like, let's say, like I see it a lot these days with like Google or Nvidia or, a lot of the Mag 7, where someone's got this huge taxable event inside of a component like that. And what a 351 exchange does is it allows you to take that single stock and actually allocate it to a new ETF issuance. And these funds have become really popular in the last year. Alpha Architect issues a few. I think they're doing 3 or 4 this year, I think. And then Meb Faber's Cambria Investments also does some. I think they partner with Alpha Architect on those products. But basically what this is it's a new ETF issue, and it allows an investor to actually allocate their high basis individual stocks to the new issuance ETF. And what the investor gets is you will actually get the ETF itself. And what you're basically doing is you're not necessarily eliminating the taxable event, but you're swapping out a single stock with the diversified equity fund. And so that's a really kind of cool and innovative way, a new way to basically reduce some of that single entity risk, where you're not eliminating a taxable event, but you're eliminating the single entity risk that you had in, say, Nvidia or Google, and you're then getting a diversified equity fund that looks basically like your 95% component, but you're not incurring the taxable event. So you're eliminating the single entity risk, not eliminating the taxable event necessarily, but you're rebalancing your portfolio without having to incur the taxable event that you would if you were to sell the Nvidia and rebalance it.
Wow. That's great. I've never heard of a 351. Is this a new thing?
Yeah, they're pretty new. They've become really popular really only in the last year. And so it's kind of cool. I mean, I partner with Alpha Architect on different products at times. And so I'm super familiar with the way that they work and stuff. And these are things that they really only became ETFs in I think the first issuance was probably like 18 months ago. So they're really new.
Wow.
But really cool, really innovative sort of methodology to get out of this really concentrated stock exposure into a more diversified sort of ETF without having to go through that taxable event.
Right. Right. What would you say if we take one step back and we go to the question, should you get out of that single stock exposure? There are a few different philosophies around it, right? So there's the, I'm thinking of my portfolio based on current valuations, and based on current valuations, I've got way too much in that single stock exposure. There's the philosophy of, hey, that 5% that I set aside, I'm framing that from cost basis, and then if it goes wild, let it go wild.
Mm-hmm.
And then I've also heard the idea of every bucket of money has a goal.
Mm-hmm.
And this 5%, this wild money or the fun money, that's not tied to any particular goal. So there's no goal or timeline associated with it. And therefore, if it gets crazy, let it get crazy, because this is not goal-oriented. This is not a goal-oriented bucket of money.
Yeah. Yeah, you're playing with house money kind of is that mentality. I think it's I love my wife has a great approach on this sort of stuff, that when you have a position that just makes a crazy return, maybe you don't have to choose to go all in or all out of it. Maybe she's a big advocate of just take half of it off. Let the rest of it ride. And that way you kind of split the difference, and you're kind of you're reducing it's regret minimization, basically, is what it is that way, if the stock continues to go up a lot, you're still riding the gains, and you can look at it and say, I'm a genius. I didn't sell all of this. And if it goes down a lot, you also can look at it and you can say, I sold half of that. I'm a genius. So, that sort of an approach is something that I really like, because it kind of splits the difference. And, you don't have to, it's one thing that I think a lot of people, kind of, it helps mitigate that sort of gambling mentality of having to make an all in or all out decision about something that is a really difficult decision.
Right. Does the answer change if what we're talking about is not a single stock, but rather crypto?
I don't think so. I mean, it's crypto is hard because it's so fundamentally different than the stock market. Like, it's very easy to look at Nvidia, for instance, today and say, well, I can see a world where Nvidia is 5 times larger in 20 years today. Whereas, the drivers of crypto are so oftentimes, they're not fundamentally cash flow driven. So a lot of them are more narrative driven, or, even something like Bitcoin. I talk about in the book that Bitcoin is something that it operates more like fiat currency insurance, basically, that especially if you live in like a third world country, it almost seems negligent not to own Bitcoin. If you live in a Nigeria or, a Somalia, and these are countries that have long histories of, their governments are experts at destroying their currencies, basically. Mm-hmm. And so not having exposure to sort of like this unique universal foreign currency like Bitcoin, it does seem negligent. And so the argument there, though, again, is it's not as fundamentally driven as something like Nvidia, which makes it a very different type of alternative asset, which makes the decision process around all of that really hard. But, again, I think you can apply that same sort of principle where, I've had some friends who made insane amounts of money in Bitcoin in the last 10 years, and they roughly did something kind of close to what my wife would advocate, where, they took they took half of the money off the table, and they reallocated it into either a T-bill and chill portfolio or a diversified stock portfolio or something like that. But they still got skin in the game there, where they're still riding Bitcoin through the future, but they've captured some of the realized gains and reallocated into something that is a little more fundamentally driven.
Yeah, I have a friend who made he bought Bitcoin very, very early in the game and made a lot of money in it, and did a sort of a modified version of that where he took out a portion so that he could buy a home in cash. And so it was a way of, realizing or locking in a little bit of that gain, but for a very discrete, big ticket, discrete purchase.
Yeah.
Yeah,
and your house is it's another asset that I talk about a lot in the book, because your house is such a unique investment. And it's what is a house? A house is basically just a big block of commodities that they're going to deteriorate over the course of time. So there's huge costs with investing in a house. And it's the funny thing about when people talk about how much money they make in their real estate investments or whatever, people typically, they remember the purchase number and they remember the sales number. And they forget that over the course of time, throughout owning this instrument, that, you replaced, 10 walls or 5 doors, and you pulled 1 million weeds. And there were all these costs of maintaining the commodities there that, actually in the long run, they reduced your real return in a huge, huge way. Homes are really expensive homes are really expensive assets. And so your house is also, though, it's a weird thing from a purchase perspective, because your house is, it's the one of the most personal assets you're ever going to own, maybe the most personalized asset you're ever going to own, because it's the place where you're probably going to raise kids, and you're going to, eat most of your meals, and all the sort of small comforts of life are going to be experienced in the house. And so it's one of the things that I think, not to get into like an economic tangent, but I think it's one of the things that people are really frustrated about in today's economy, is that the fact that housing is so unaffordable is really frustrating, because housing is so important to people. And I think especially when people are renting or whatnot, they maybe feel like, oh, like this isn't mine. And that the unaffordability issue is really frustrating and leading to things like the low consumer sentiment surveys, because it stinks to not be able to even have the optionality to be able to afford a home, because it's such a personalized asset.
Right. Let's talk principle number 4. Diversification is the only free lunch.
Yeah, so this is the basic principle that when the example I use in the book is that if you own just NVIDIA, you're not diversified. But if you buy something like, let's say, like a consumer discretionary stock, like let's say Procter and Gamble, it's a totally different type of business. They're diversified in very different ways. And the interesting thing about owning these two instruments together is that they're going to generate very different types of returns over the long term. And so the simple example is where the two instruments actually generate the same return over a certain time horizon, but they do it in the exact opposite way. So one goes up a lot, one goes down a lot, and then they both end up roughly at the same point. And what happens over the course of time there is that portfolio actually looks like kind of just a straight line. If you had an equal weight allocation in the two of those, your portfolio on a risk-adjusted basis, it did way better on a risk-adjusted basis, because you created a much more predictable and stable return stream by just owning this other instrument. And so the basic principle of diversification is that it's a free lunch, in the sense that you're mitigating some of the volatility inside of the portfolio by eliminating that behavioral risk that you've got when that asset goes down, the other one. You might be tempted to sell there when it's going down, but in the long run, the fact that you own the other one, it offset that to a large degree. And so, like I said earlier, Brian Portnoy likes to say that diversification is learning to hate some part of your portfolio all the time. And, weirdly, that asset going down could be a really good thing in the intermediate term, because it's potentially offsetting some of the performance that might happen later on in life where, when that other asset that went up a lot, when it goes down, maybe the other one's going up a lot. And so it's the other basic principle behind owning something like bonds in a portfolio is that, or owning, T-bills in a portfolio is that typically when the stock market gets really scary, the T-bills will keep you calm. And even though they're lagging, 95% of the time over which the stock market is performing, that 5% that's really scary, that 5% of the time when the stock market goes through a bear market, it's going to frighten the hell out of you. But that T-bill component will keep you comfortable. And the fact that it's lagging most of the time is actually a good thing in the long run, because it's creating diversification that over the 100% course of the return stream, it'll keep your entire portfolio kind of more viable.
I think one thing that often throws a lot of people for a loop is that they think that they're diversified, but the reality of finding assets that either are low correlation or inverse correlation is more challenging than it appears in this increasingly connected, interconnected economic environment.
And that becomes really acute too. Anybody who invested in 2008 knows that, there was nowhere to hide in the stock market.
Right.
Utility stocks were down 65%. So the things that people think of as like even the safest components of the stock market, they can get really, really scary when things get really, really bad. And COVID was kind of like this too, where, just a lot of asset values just all went down at the same time. And that's the thing that makes a strategy like risk parity potentially more interesting. Or one of the strategies I talked about that we didn't mention yet was trend following, which is the strategy that the trend following traders, what they're basically doing is they're buying commodities or true alternatives, and they're just riding trends. And the interesting thing about that is that those sorts of strategies, they oftentimes work best when everything else is terrible. And so typically inside of like stock market crashes and things like that, the trend followers they're short the market, because what trend followers are trying to do is they're trying to capture what looks like a small trend with the hope that it eventually becomes a really big trend. And that's kind of like the best trend followers are really good at capturing those types of events. And they're not biased against being long or short. So a lot of the times, they're buying weird instruments, or they're shorting weird instruments, and they're getting exposures that are truly, totally uncorrelated. And that's one of the things that, you're getting into markets there where you're finding versions of greater diversification in a strategy like that aren't necessarily going to be viable inside of like a 60-40 or, just segmenting yourself to stocks and bonds.
So as of the time that we're recording this, which is at the beginning of 2026, we're seeing, right now the stock market is high, but gold is also high, which is not something that you necessarily see. You typically don't see those two high at the same time together. I guess, how do you make sense of that? In the context of trend following, in the context of like, we're seeing things now that we don't normally see.
Yeah. It's a really sort of weird time to be an investor, because I think that the arguments in benefit of diversification are stronger than they've ever been, because the disparity across so many different asset classes is just wider than it's ever been. And this is most apparent with the US versus foreign like CAPE ratios. If you look at this is the cyclically adjusted PE ratios, the United States is at 40, which is basically equivalent to like what it was during the NASDAQ bubble, and foreign stocks are at like 22 or something. And, the weird thing going back to the NASDAQ bubble was that these two components, they tracked each other almost perfectly through the NASDAQ bubble. But today they've like gone in completely different directions. And so it's a very, very different environment. But you also see it in the disparity in commodities last year.
Right.
The silver was up 150% or something.
Yeah.
I think gold was up 70s or 60 or 70%, whereas the average commodity was only up like 16%. So you had this huge disparity in the commodity market. So, I'm not typically like a huge advocate of buying commodities in general, but I would say that in this sort of an environment where you've got these huge disparities in returns, diversification, again, makes a huge amount of sense. We're going out and buying, if you want to own commodities, I think it makes a lot more sense these days to own a diversified commodity basket versus owning something individually like, the Harry Brown permanent portfolio talks about how gold is the only component that they own there as like the inflation hedge, which is potentially like much higher risk these days, because the way I like to think about really high return markets is that when you generate 60% inside of a single year, you create like what I call a price compression, where if gold on average, let's say it generates 8% per year. When you take 60%, what you've done is you've basically taken 8% and you've compressed all these long-term returns way down into the short term. And what does that do? It creates potential for sequence risk again, where let's say you get, you might average 8% over the course of the next 50 years. But if that includes 60% in year one, well, that means that along the way, you're going to get a lot of negative volatility along the way. So I think, again, going into this sort of an environment, you have to look at something like gold and say, my potential for sequence risk is through the roof right now. And that may not necessarily be a bad thing in the very long run, but it might expose you to a huge amount of behavioral risk in the short term.
People often say that behavioral risk can be offset by having a very clear investment thesis. Does that actually work, though? Does having a very, very clear investor policy statement help you hold on to it when things did not go the way that you expected?
Yeah, I mean, I think it's one of the things I tried to really communicate clearly in the book, is that you should understand what you're doing, and having a process. And, going back to the Warren Buffett methodology, I think one of his superpowers is that Buffett built this really brilliant process through which he does everything. And he stays like steadfastly disciplined to that process. And so not only does he have this like incredible understanding of the things that he's buying and holding in the long term, but he has this process that he understands so well that, I do think that if you don't understand the things that you're buying, you will second guess them at times. And it's an interesting one for me from like a behavioral perspective, because I've seen this front and center in my own business, where sometimes I understand something really well, but if the people I work with don't understand it almost equally well, they'll come to me at times and they'll say, hey, this thing isn't performing well. I don't understand it. I'm now second guessing you. And that creates behavioral risk, where people then look at something, when you get involved in something that maybe you didn't fully understand, you then look at it and you start to question it. And that creates the risk that, especially when things are, no bueno, that creates the risk that then you're going to sell into the downturn, which is like the worst possible thing you can typically be doing. And so you got to go into this whole process, I think, with a really solid understanding of, what is the process? What are the things I'm owning? And do I feel fully comfortable with my understanding of all of it, knowing that, weird things are going to happen and I'm going to expose myself to environments where I might second guess this, but, I understand this stuff well enough to know that, hey, yeah, it feels risky in the short term, but I know in the long run, the probability of the outcomes to stay comfortable with it.
At what point does diversification become diversification, and how does that happen?
God, how does it typically happen? It usually happens with a bad financial advisor, in my experience. You wouldn't believe the number of portfolios I've seen where somebody will come to me with, 50 different holdings, and they probably look roughly like the S&P 500, and I run the math on it, and I'm like, oh my God, like you could have owned one index fund, and this would have looked exactly the same. But the financial services industry has mastered the art of making things look very, very complex to, I think, make it look like, this is, oh my God, this is so difficult to do that you have to pay somebody 1% a year, or else you'll never be able to figure it out yourself. And you see this with like all the big brokerage firms. I always laugh at looking at their like financial statements, because you get like a monthly statement and it, the thing is like 15 pages and half of it is illegible or written in language that, nobody can decipher. And it's all, I think, part of like the confusing nature of finance and the way the industry's kind of been constructed. But, I think that it's important to look at a portfolio and understand what you've constructed, to know that, hey, did I do something that made all of this overly complex in a way that, relative to something really simple like an S&P 500 index fund, would have been way lower cost and just way, way easier to manage. And so it's one of the dangers with stock picking that, you can very quickly get into a portfolio where if you have 25 or 30 stocks, you probably own something that looks a lot like, whether it's the Dow or the S&P 500, it probably looks a lot or has a very high correlation to the S&P 500. And so you can very quickly get into an element there where you have to question, hey, was there a simpler way to do this? And, I think the biggest danger of diversification is when people start trying to make things overly elaborate, where they're building a portfolio that, like kind of going back to that risk parity portfolio, where finding 15 uncorrelated return streams is really, really difficult, and a fast track to diversification, because before you know it, you've got 15 different really opaque, sort of unusual components in a portfolio where maybe this thing is really no better than like a 60-40 portfolio. So I think this is the other thing about financial services is it's an industry that is made up of very, very brilliant people, but also people that love to overthink things and build things that are overly complex, in oftentimes with the intent just to sell the product to somebody. And so it's very easy to build in layers and layers of added complexity that, maybe they're not that beneficial compared to something like, a 60-40 portfolio, or understanding, like, it's one of the reasons why I'm such a big advocate of understanding the global financial asset portfolio, because look at that portfolio and then you can benchmark everything to that. And you can say, okay, well, I've got 5 different mutual funds and 10 different ETFs, and then I own 25 individual stocks. And looking at that and comparing it to something like the global financial asset portfolio, is it really any better? And the GFAP, as I call it, the global financial asset portfolio, it can be owned with as simple as like 4 ETFs. And so you've got to benchmark things correctly and understanding from a correct starting point, so that you're not just building in layers and layers of complexity, not too dissimilar to the way that, like, we were talking about different accounts earlier,
Right.
where, you can get all these different accounts in different places over time. And before you know it, you've diversified everything because you've just made everything unnecessarily complex.
Mm.
And keeping things simple, it just will make everything much more manageable in the long run. But it's a balancing act too. You don't want things to be too simple to the point where it's counterproductive, but you want to find that right level where you're also not just making so much complexity in the portfolio that it becomes impossible to manage, or the different elements are just so costly that they start actually being counterproductive relative to your returns.
Unnecessary complexity is essentially the factor that makes it worse. And that same unnecessary complexity can also, especially if you're not working with a financial advisor, can make you freeze because you get frozen by indecision.
Yeah, I mean, and I think that's part of the complexity aspect that, it's so important to be really well organized with all of this and make it, you want it to be complex enough, but not so complex that it becomes counterproductive. I try to distill all of this down into, as simple as it should be, but it's subjective. So, the overarching message of the book is that you've got to do what's right for you. And, that's such a personalized and subjective sort of thing, but it's something that is a balancing act, because there's a fine line between building something that is way too complex and then building something that is way too simple, to a point where, like, I'm a little bit critical of the 3-fund portfolio in the book, because you can argue that the 3-fund actually requires more funds. Maybe it requires a cash fund, or, you could argue maybe it's not aggressive enough, like the 3-fund portfolio isn't appropriate for Paula, but it might be more appropriate for like a retiree or something. And so it's a balancing act, and it's personalized.
Right. And with something like a 3-fund portfolio, you don't really have much opportunity to practice asset location.
Yeah. And that gets into, like, real financial planning and the aspects of all of this where, especially the older you get and the closer you get to retirement. I mean, when you have kids and things like that, life gets really complex. And so I think this is something that a lot of people struggle with as they get older, is that your life gets really complex as you get older, and it gets more unpredictable also as you get older. And like being young and having a decent job and having a lot of time, it's like the easiest time to be an investor. And I think it's one of the reasons why a lot of young investors take a lot of risks, is because they kind of know they have the flexibility to be able to do that. But when you get older and life gets more complex, it actually, I think, becomes even more important to simplify your portfolio, because everything else in your life is so complex that you don't want to deal with a lot of excessive complexity in managing your finances. And so distilling that down into like a really simple portfolio, it can be accretive to the rest of your life in really beneficial ways, because you're offsetting some of the complexity that you've got in the rest of your life that's inevitable.
Right. Let's talk about the fifth principle, the cost matters hypothesis.
Yeah, so this is probably John Bogle's most famous conclusion. And, Bogle, we talked earlier about the 60-40 portfolio and the origin story of it. And one of the most interesting components of the 60-40 portfolio was that Walter Morgan eventually hires John Bogle to run the Wellington Fund. And so it's kind of the thing that made the Wellington Fund most famous and ultimately led to like Vanguard and Bogle's fame. But the most famous thing that Bogle was an advocate for, and the reason why Walter Morgan hired him, was because Bogle wrote a really critical thesis paper at Princeton about how important costs are, and how changing the cost structure of the industry could be really beneficial in the long run. And so this kind of became Bogle's probably most important contribution to the whole industry, was that he became the advocate of the low cost index fund. And he talked a lot about how these seemingly small numbers add up to humongous numbers in the long run, and how, that 1% figure, it doesn't seem very big when you just think about it. You're like, oh, 1% doesn't seem like a lot. But when you think of 1% as being 1% of that real return in the long run, let's say it's 5%. Well, wait a minute. Now, all of a sudden, 1% of 5% is actually 20%. And all of a sudden, 20% actually is a lot. And when you add in the fact that this is a compounding return over the course of the long run, that fee can, in the long run, it can add up to, for a lot of people, it'll be hundreds of thousands of dollars. And so the old book was called "Where Are the Customers' Yachts?" And the reality is the customers' yachts are sitting in the harbor, across the street here, because they're owned by the financial advisor who was charging 1% a year.
Right. Right. And sometimes, like for example, inside of an HSA, there are such limited choices, and there's a necessary fee that you have to pay, and just I think a frustration that a lot of people, I'm sure a lot of people who are listening to this have. There are probably a bunch of people who are listening who are saying, I have an HSA or an employer-sponsored 401k or maybe a 529 plan, where there are just these fees inside of it that I can't escape.
Yeah. And you feel trapped. It's, the traditional financial services industry, it moves at the speed of molasses in a lot of ways, where, especially these old legacy structures like 401ks, they still have not fully evolved. And it's one of the crummy things about the industry, is that we haven't updated these things fully to reflect even like I'm a huge advocate of owning ETFs over mutual funds, for the basic fact that a mutual fund is it's a far worse product wrapper from a tax efficiency perspective. That the ETF, the beauty of the ETF wrapper is that ETFs are able to they're able to reallocate and diversify their assets inside of themselves in a way that doesn't necessarily spit off capital gains distributions. And so at the end of every year, we see these capital gains distributions reports from mutual funds. And I mean, you could buy a mutual fund in July that issue and have a zero gain in it by the end of the year, and you could still get a tax bill from that fund at the end of the year, because they distribute some of the shareholder capital gains distributions in it. Whereas ETFs are much more easily able to eliminate or mitigate that risk because of the way that they fundamentally operate, the way that not to get too deep in the weeds about like the structure of the product itself, but ETFs do what are called in-kind redemptions. And so rather than cash redemptions like the way mutual funds operate, ETFs operate in a fundamentally different tax structure, basically. And so they're much more tax efficient instruments. And so, it's actually one of the weird things with the cost matters hypothesis that Bogle didn't love ETFs. And it's one of the few things that I think Bogle got wrong in his career was that he was really critical of ETFs because he thought that they necessarily induced like more of a trading mentality because they trade on the exchange all day. Whereas a mutual fund, it basically, it doesn't necessarily trade on an exchange. It settles every day at the end of the day, basically. And you can only buy and sell it basically once a day. So there's not this like gambling mentality, and Bogle was very specifically critical of the gambling mentality, but he also was just generally critical of ETFs in general because I think he thought they induced that need, which I don't know. I think that can be mitigated just with good disciplined behavior. But it was an interesting thing to think about in the scope of like the cost matters hypothesis, because ETFs are, from a total return perspective, they can be far, far lower cost than mutual funds and other types of instruments. And so they're hugely beneficial. And the industry just, even to this day, the amount of assets in mutual funds is still enormous relative to ETFs. And so it's a slow moving change, but we're moving in the right direction.
Right. So first, just to clarify for the audience, when you say mutual funds, you're including index funds in that, index mutual funds. Right?
Yeah.
I think often, colloquially, people will often distinguish actively managed mutual funds versus index funds. And but when you say mutual funds, you're also referring to index funds.
In the defense of some mutual funds, like the Vanguard mutual funds, for instance, they were able to basically eliminate this capital gains distribution event because of the way that they had a patent actually on the ability to use their ETFs the same way they basically use all their mutual funds. And so Vanguard's kind of a unique beast in that sense. But yeah, I mean, index mutual funds, and I'm generally being probably more critical of like the actively managed mutual funds that are doing things like, maybe they're buying, or implementing like a risk parity strategy inside of the mutual fund wrapper. And when those funds are rebalancing and being active in the underlying, they're incurring capital gains potentially that they have to, by law, distribute to their shareholders.
And so does this, for a person who's holding these assets in tax-advantaged accounts, does this matter inside of a tax-advantaged account, or is this something that you should really only be concerned about inside of your taxable brokerage?
Yeah, no, it's not as big of a deal. I mean, I don't know, just from a practitioner's perspective, I always default to ETFs. I mean, like one of my favorite stories is when I was a young analyst at Merrill Lynch, beginning my career, I remember like looking at the iShares ETFs had sort of just come out at that point, and they were basically brand spanking new. But I was looking at these and studying them, and I'm thinking, like, we own all of these actively managed mutual funds for our clients. And I go to my boss one day and I was like, hey, there's these ETFs and they seem to do the exact same thing that the mutual funds do. They generate roughly the same returns, but the fees are like, a fraction of what the mutual funds are. Like, what are we doing here? Like, why are we buying the mutual funds? And, my boss basically said, he was like, well, you get paid to sell this one and you don't get paid to sell this one. So you can sell this one if you want, but you're just not going to make any money working at this firm. And I was like, okay. And I up and left like 6 months later. But so I'm just a huge advocate of ETFs because I just think that the ability to buy and sell, the liquidity, the innovation in a lot of the different ETFs, like we were talking about the 351 exchanges, this is still a component of the market that is, I think, relatively young compared to mutual funds. And the wrapper itself, I just think is superior in numerous different ways, as long as you can, restrain yourself from that temptation to kind of buy into the gambler's mentality. And to Bogle's credit, he weirdly has been right in some ways, in that there are a lot of like really crazy ETFs coming on the market all the time now. Like, I see these things like the super triple leveraged ETFs or whatever they might be. Like, these things are these are instruments that, especially on an after-tax basis, like they are just crazy, crazy expensive. And they're feeding into that like gambler's mentality of like, oh, you're only getting 1x the S&P 500 return. Well, wouldn't you be better off with 3x? And it's like, well, no, in a lot of ways, you'll actually be way worse off because of the excess volatility, the excess fees, and all these other things that they kind of feed on that gambler's mentality. But, when it comes to just, plain vanilla sort of indexing style ETFs, they're really, really hard to beat.
Right. Outside of fees, where or how else should individual investors appropriately tuned into costs? And where I'm going with that is financial advisors in general. There are a lot of people who say, well, the voices on the internet, the keyboard warriors on the internet who will say like, you don't need a financial advisor. You can figure all of this out on your own. Or, you don't need to pay for coaching or training or classes. You can get any answer that you want through like Google or now prompts. But I would argue, or I think some would argue that people will shortchange themselves by not getting education or not hiring advisors. Not building out that team, that structure, that support. So, to what extent is it appropriate to be tuned into costs, and to what extent do you actually harm yourself by being too concerned about the pennies?
Yeah, it's hard. I mean, it's one thing I see a lot working with individuals is that you don't know what you don't know.
Mm-hmm.
And so if a financial advisor has some sort of unique understanding about something that you just don't know about, then what's the benefit of having worked with that person relative to the alternative? So it's a super personalized thing. And I think it's one thing that's really important actually when picking a financial advisor is that, or considering whether to work with one in the first place, is that what are you really paying for? Are you paying for a 60-40 portfolio that, this person is going to basically tell you, during the course of a bear market to, hey, stay the course? Like, is that what you're paying for? Because I would argue for the vast majority of people, that is not worth paying for a financial advisor for. Whereas, if you're paying a financial advisor to do detailed financial planning and structuring a portfolio in a way where, it's based on a financial plan and you're getting the benefit of like, help with Roth conversions and doing things like required minimum distributions and, things that are a little more difficult for your average investor to handle on a daily or monthly basis. That's a totally different structure. And, it's also important, I think, to understand the different types of fee structures where, like, I'm generally a big advocate of flat fee financial advisors where you're paying someone a flat fee more akin to like the way you might pay your doctor or your accountant rather than like, that compounding effect of paying an AUM fee, an assets under management percentage fee, where that number can add up to a lot of money really fast. And so the funny story that I steal from Meb Faber is the story that he tells about when if you have $1 million and you pay 1% fees a year, think of this as you go to your financial advisor once a year, and before you go into that meeting, you take a briefcase to the bank and you take out $10,000, and you walk into the meeting and you walk out without the briefcase. And, that's how big of a fee that is. And on an AUM basis, and again, this is a compounding fee, it's something to be really mindful of, not just the amount of fees you're paying, but the type of fee you're paying. But then there's also other fees. There's, the biggest fee arguably is the inflationary fee that we all pay every year along the way. And so you have to build in an inflation hedging component to the portfolio where, if you're in a T-bill and chill portfolio, you're not really getting much of an inflation hedge. Maybe you're not getting an inflation hedge at all. 10 years ago, you weren't getting an inflation hedge there at all in that portfolio. And so you have to layer in things that will, compound in a way where you're offsetting that cost. And then, there's the other big fee, which is taxes. Taxes are ultimately one of the biggest fees, maybe the biggest fee you're ever going to pay in the long run. And so you have to do things, you mentioned tax location earlier, that you have to structure a portfolio in a really thoughtful way where you're optimizing for taxes. But again, this is something that it's a balancing act, because taxes are something that I think people can kind of start to over optimize for. Like I, to some degree, have gotten away from owning like municipal bonds for people because behaviorally, I think they confuse a lot of my clients. But also, you can start getting into structures where, like you start using certain instruments in different accounts where maybe they're not like the most beneficial. Like a lot of people will actually argue from a tax location perspective that like you should put your bonds in your retirement accounts because bonds are typically pretty tax inefficient instruments. And I would look at something like that and say, well, wait a minute, I think that's actually completely wrong, because if this investor is, say, 30 years old and they've got a 40-year time horizon here, they might not be required to start withdrawing from that IRA till they're like 75. In which case, this person has a 45-year time horizon. There's an argument there that bonds are a completely inappropriate allocation because based on the time horizon, you're subjecting yourself to inevitable low returns in that allocation. So again, it's a super personalized thing, but you have to be, conscientious of all of these different types of fees that you're going to be paying, whether it's the actual fees in the funds and the cost of management, or if it's inflation, or if it's taxes.
Let's talk about principle number 6. Real returns are all that matter.
Yeah. So one of the things that I really emphasized in the book was that when I portrayed all the data, I did it on an inflation adjusted basis, because the main reason that I did this was because we sometimes hear the gross figures in the financial media, and you hear things like, oh, the US stock market does 10 to 12% per year. And, kind of going back to the emphasis on all of the fees we pay along the way, inflation is a biggie, taxes are a biggie, and then the actual fees in the underlying are really important. And so when I talk about real returns, I'm trying to back out all of these other costs. And I think that's the right way, because this is the return that you actually eat. This is the return that you can actually, at the end of the day, go out and spend. Because, once you liquidate something, you'll have to pay to, offset inflation for whatever the goods and services you're buying are, but you're also paying the taxes ultimately from having distributed that, or liquidating the instrument. And so, this is the actual money that matters. It's the money in your pocket. And so that 10 to 12% figure is exaggerated because it's unrealistic. It's not the actual money that you're going to end up with at the end of the day. And so I portrayed everything on this real return basis to try to emphasize that, hey, especially with the stock market actually it's not going to generate as much of a return as you really think it will, because when you liquidate the stock holdings and actually go out and pay for things, the actual dollars in your pocket are going to be far lower than the gross figure that we talk about in the financial media sometimes.
There's the distinction between nominal dollars and inflation adjusted dollars.
Yeah.
There's all of these forces that eat away at those returns. There are those who say that a big sort of purpose behind investing is simply trying to beat inflation. That if you can beat inflation plus have some additional margin of a few percentage points on top of that, that's really the game that we're playing here. Would you agree with that?
Yeah, to a big degree it is. But it's a balancing act, because you're trying to do two things with a savings portfolio. You're trying to build a certain amount of principal that is predictable. You want to have predictable sort of pools of money at certain points in your life to, especially, working from like a financial planning basis. Like I like to emphasize the strategy that I call defined duration, which is, it's basically like an asset liability matching strategy where you're actually trying to construct expenses in the future, and you're creating almost like a bucketing strategy where you're creating pools of money that are funding very specific needs into the future. And so, using like a really simple example, let's say you just want 2 years worth of emergency funds, and then you've got a house down payment that you're, maybe looking at at some point in the next 2 years. And then you've got, maybe a kid going to college in 10 years. You can, from a planning perspective, you can actually quantify what these numbers are going to be, and then you can match them to very specific instruments that, are going to be matched to specific time horizons to fund that need. And then from a planning basis, you kind of know like, okay, I've got, going back to Bill Bernstein's tips ladder, like if you build a 10-year tips ladder, you can go out all the way to your kids' college, needs, and you can build this tips ladder in a way where, from an inflation adjusted basis, I'm going to have exactly this amount of dollars to fund this need over a certain time horizon. In the long run, inflation is in a lot of ways the whole ball game, because you need to adjust for inflation to be able to consume the future goods and services that are going to be inflation adjusted. And you've got to build a portfolio, though, that also has the nominal principal stability to be able to predictably consume. And especially if you're drawing down a portfolio, this becomes even more important, where you need pools of sort of short-term money that hopefully, these days, the great thing about like the T-bill and chill component is that you're generating a real return. You're getting actual inflation protection inside of that instrument. But you've also got to build in the fact that the stock market is typically the best inflation protector, because in the long run, what do corporations do? Corporations, they buy things at cost and they try to sell them at a markup, basically. And the return that stocks generate is a function of that markup, basically, the profits that they distribute in the long run. And what I call one of the next principles is the temporal conundrum idea, that the allocation of savings is a temporal conundrum, that you're trying to consume in the short term, but you're allocating assets that are on average in the long term. And this creates temporal confusion for everybody, because you don't know how much money you're going to need in the future, but you want to allocate it to assets that are going to grow enough that you can fund your needs in the future.
And so let's talk about that, because you want to be able to fund your needs in the future, but you don't know what those needs will be, and you don't know how long that future will be. So with retirement planning in particular, let's even just take the standard, quote unquote, standard age of 60. You still don't know if you're going to live to be 75, 85, 95, 105, right? You've no idea what and I think it's hilarious that it's called, quote unquote, longevity risk, because only in financial planning is living a long and healthy life considered a risk, right? But there's the risk that we might have a long life, Most places that's a reward and not a risk. But yeah, so we don't know how much time we're planning for. And the great unknown, are we going to need assistance with activities of daily living? Are we going to get to a point where we are no longer able to cook our own meals and button our own shirts, and we're going to need to hire help for that, right? And so the standard thing that people say when they're young, which is I'll just adjust my lifestyle, might not be an option in old age, right? Because some of these, there's that necessity of spending. So how do we deal with that?
Yeah, it's a great thing to talk about, because it's interesting to talk about asset management in the concept of allocating our savings, but what people probably don't talk about enough is liability management as well, because one of the things that Bogle liked to talk about is how you should control what you can control. And like fees are something that you can very acutely control in your portfolio. You can very acutely control the way you're diversified. But the other thing that people can control, especially when they're younger, is their liabilities. Like, and this is kind of gets into the conversation of like needs versus wants. I think that one of the great superpowers of investing and having a good financial plan in the long run is understanding your needs versus wants. And Bogle actually wrote a whole book called Enough. And understanding, what is enough for you? And, do you need to constantly be chasing where the grass is greener, and, finding that point in life where you just feel like you have enough will, in a lot of ways, it'll enhance your overall financial plan, because you get to a point in life where, if you discover what is enough for you, you be able to control your liabilities in a very controlled manner, where you say, I don't need a Ferrari. I could afford a Ferrari, but I just, I'm totally happy with a Honda Accord. I know it may not be as flashy or, as fast getting me from point A to B, but it's still going to get me from point A to B in a really reliable way. And so that liability management is really important in the context of all of this, because it's arguably in a lot of ways, it's maybe more important than the asset management part of the whole equation. But again, it gets really hard, especially when you get older, because the liabilities become fixed to inflation. And in a lot of ways, they're fixed to the worst components of inflation. Like, the real risk of longevity risk is healthcare costs, basically. And healthcare is something that is probably only going to get more and more expensive as we all get older, especially as the demographics of the current economy kind of continue to deteriorate, where everyone's living longer and people are seemingly less healthy, and so the healthcare inflations are going to be, probably, one of the biggest risks going forward. So, it's one thing I make a ton of, bad leg day jokes in the book. And, part of the
don't
thinking,
skip leg day.
Yeah. I keep reminding people, don't skip leg day. And, it's a corollary to all of this in large part because maintaining a healthy lifestyle is probably the best liability management that any of us can do. And so, not that I'm like a fitness guru or fitness expert by any means, but it is from a financial planning perspective, like one of the things that's probably the most important element of managing your longevity risk and your liability management in the long run, because it's one of the best ways to mitigate your healthcare risks in the long run.
Right. And to the extent that fitness can facilitate that, that's great. The challenge in financial planning is that I have no idea if I might suffer dementia.
Yeah.
And if I do, that presents me with a major expense. There's all of the expense associated with knowing that I will need to pay for whatever care is required at a time in my life when I am increasingly incapable of being able to pay my bills.
Yeah. It's especially hard with, I do a lot of what I call asset liability matching with people I work with. And it's one thing that's really hard with especially older people, because you're trying to build certainty into the portfolio in a way where you're trying to match assets very specifically. And like I wrote about how, Bill Bernstein is a big advocate of long duration tips ladders. And the reason he likes that is because he says that you can match the long duration assets to long duration expenses. And, I'm a little bit critical of that idea because of what you're saying, that those long duration expenses are totally unpredictable. And I actually think that long duration bonds, long-term bonds, I think they're actually really terrible matching assets for long-term expenses, because those long-term expenses are so unpredictable that you're almost, I would argue, certainly better off if you've got a 20-year time horizon. You probably can and should take stock market risk with that component of your portfolio, because, it's not 100% guarantee. Like that's the beauty of the 20-year tips instrument, is that thing has 100% certainty of having the amount of money basically that you quantify out. But the problem is that the opportunity cost of not having owned the stock market that whole time is probably, just gigantic. And even though it's not 100% guarantee, over rolling 20-year periods, the stock market will outperform things like tips, 99% of the time in historical terms. And so, it's not a guarantee, but it is a super high probability outcome. But it's one of those things that from a planning perspective, it's really hard, because you're necessarily trying to make these predictions about things. And it's one of the reasons why I think it's so beneficial to take diversified stock market risk over the long term, knowing that it's a long-term instrument, because the probability of that thing funding those unpredictable needs is much higher than trying to peg it to something like a 10-year treasury note yielding, 3.5% or something like that, where you're locking in a low real return that probably is not going to come close to paying for things like healthcare costs in the long run.
Right, exactly. And you have, as you alluded to earlier, a lot of the expenses that we pay, particularly as in older age, rise at a rate that exceeds inflation. Healthcare being one of them. Car insurance recently has
all insurance,
right? Yeah, exactly. Property taxes,
yeah,
often exceed insurance, right? And these are
it's one of the screwy things with inflation, because inflation is a hyper personalized thing. We talk about things like the consumer price index, and the government issues these like nationalized levels, but the reality is that your personal inflation rate is probably completely different than what the CPI is. And living in New York, or I live in San Diego, like the inflation rates in places like that are wildly different than they are in places like Idaho, or other the parts of the country. And so again, it's a super personalized thing, and you've got to actually understand it and quantify it at a personal level.
Right. Is there anything else that you want to add before we move on to
Yeah, no, this
the
is
eighth
a
principle?
famous Ken French quote. And the reason I like it is because it's kind of all encompassing. And, we, in sort of academic terms, like we define risk as basically standard volatility or standard deviation or volatility. And, it's kind of a neat little academic function because it's quantifiable. But for your average person, volatility isn't necessarily a risk. In fact, volatility could be like we were talking about with the stock market risk. In the long run, stock market volatility is a really good thing because it's the thing that correlates to higher returns in the long run. And so, you've got a lot of different definitions of risk. And the reason I like the Ken French quote is because when you think about it, about your ability to consume in the future, it involves things like inflation risks and fee risks and volatility. And when you think about your ability to consume out over different time horizons, you can then start to think about risk in a little bit of a different nature, where you're customizing it more to a financial plan and the actual risks that are exposed inside your financial plan, rather than these sort of like, jargony academic concepts like volatility or standard deviation.
People often, especially if you're in your 30s or 40s, you kind of have to use these extremely like heuristics and shortcuts and rules of thumb, because what else can you do
Yeah.
that there's no way that you can in any way accurately predict your needs or costs in your 80s or 90s,
Mhm.
50 years into the future.
I talk about this a little bit in the defined duration chapter, where I try to think about this stuff in very specific time horizons, where like you said, 10, 20, 30 years out, who even knows what the world's going to look like then? I've
Right.
got a 4 and a 5-year-old daughter, and I have no idea, like, are they just going to be sitting around the house all day, like being served by robots all the time, like when they're 50 years old? Like, I have no idea. The world's going to change so much between now and when they're 50 years old that it's like crazy and unpredictable to think about all this stuff. And, so you do have to just sort of block that out in a way where you sort of say, like, I don't know what that's going to do. But where it's really important is I think you can also like create a lot more predictability across different time horizons. And so I try to emphasize with people, especially like the people I work with, that the most important time horizon is the 0 to 5 year time horizon, because the 0 to 5 year time horizon is the one where you can actually, to some like sort of rigorous way, actually quantify all the needs out over the course of 5 years. You can inflation adjust an emergency bucket or, expenses out over 5 years. And you can kind of know, okay, inflation is unlikely to deviate too much from, my estimate over this time horizon. You embed like a, 3 to 4% inflation adjustment or something like that. But you can also predict things like, hey, I've got a 15-year-old car, and I know this thing's going to kick it in the next 5 years. So I've got to block out, 50 grand to go buy a new car. I don't know when in the next 5 years, but at some point in the next 5 years. Or, my kids are going to college in 10 years. Like there are certain things that are somewhat predictable, but I do think especially that 0 to 5 year time horizon, that's the one that is the most predictable. And it's where good financial planning can really function well, because you can then start to build out these sort of like, whether it's bond ladders or, like I like to talk about it in terms of like asset laddering in the defined duration chapter, where you're building a financial plan and then you're matching assets very quantitatively to the 0 to 5 year buckets in very structured ways, where you kind of know like, I've got X number of dollars to cover, Y expenses over these time horizons. And the biggest benefit actually of having seen this implementation in real life is the way that clients actually will see the front-loaded certainty of the expectations or the liabilities being structured in this sort of a methodology. And it frees up a ton of behavioral bandwidth where, before when I would do risk profiling, like the traditional sort of financial planning way to do all this is to say like, okay, like you get scared when the stock market goes down a lot, or you're 60 years old, so maybe we need 40% in bonds or something like that, and using these sort of heuristics, and then you run a Monte Carlo simulation through your software, and it says, okay, well, based on your 60-40 allocation, we know that your financial plan with your starting balance, it has a 99% success rate in the long run. But you're not giving anybody like the understanding of, am I going to have money at certain times in life to pay for certain things that I need to? And by blocking these things out in more of a time segmented fashion, you're then matching very specifically to the most predictable time horizons. And when you block out that 0 to 5 year time horizon, it's interesting. I notice with a lot of people that I work with that they actually end up being able to take a lot more risk. And so you might not have 60-40. You might end up actually being like 70-30, where the investor's taking more risk because they've quantitatively taken that 30% component and they've blocked it out over, say, 0 to 5 years or 0 to 10 years or something like that in a rigorous way where that person knows, well, I've got 30% of my assets here, and I'm covering 5 to 10 years of all of my expenses and my car purchase and, my house down payment or something like that. And that frees up the 70% for me to take risk with, to take long-term risk. And so it's, for me, kids did this weird thing to me where they forced me to think across different time horizons very specifically, because before I had kids, it was basically just me and my wife's money. And I was kind of like, I was 100% stocks. And I was just like, oh, this is all long-term money. We both have good high paying jobs, and, we don't need this cash or this allocation, so we can be super high risk with it. Whereas once you have kids, all that goes out the door, because then you have to start thinking about like, oh, like I need to pay for diapers, and I need to pay for, daycare, and I need to pay for school down the line, and I need to pay for, a college tuition potentially in 20 years. And then I want to also think in multi-generational needs, where it's like, I want to leave my kids some money, like I am a big fan of the die with zero component, but I also like Warren Buffett's quote about giving your kids enough to do something, but not enough to do nothing. And I think that's a great way to think about multi-generational inheritance needs and whatnot, because you want to give your kids some, certainty in the future, especially because, from thinking about the future again, I don't know what the world's going to look like. Like, what if inflation is crazy high and my kids are, unable to get jobs because the robots are doing all the work in the future? And, it's to my benefit to work hard now and try to provide a little bit for them down the line, knowing that, I can give them something. But also that's a super long time horizon. So it adds in that layer of multi-temporal thinking that is required in good financial planning.
And that actually ties perfectly with your next principle number 8, which is that asset allocation is also a temporal conundrum.
Yeah. I mean, this is the thing that is the most important thing for all of us, is time. It's the most valuable thing that any of us have. And it's the thing that makes portfolio construction really difficult, is navigating all of those different time horizons. And so when I say it's a temporal conundrum, I say that, it's unpredictable. It's navigating future consumption across all these different time horizons. And so time is the thing that it's like the one thing we all understand universally. And it's interesting from like a portfolio construction process too, because the industry has specialized jargon around like factor investing and style investing and, mid cap and small cap and large cap and growth and value. And to your average person, they're like, I don't know what any of these things are. I personally, I couldn't even define exactly what a mid cap is. I don't, off the top of my head, I don't know what is the actual market capitalization of what comprises, the mid cap definition right now. Your average person definitely has no idea of what these things probably even are. Like, they have some vague concept of it. Like, what is a value stock? Well, I assume it's a stock that's selling at a good value. And it's like, well, duh, but, even the pros can't actually identify what that thing is. If everybody knew what the best value stocks were, everybody would generate the best returns. And so, we talk in the industry in these very sort of like, almost like alternative languages sometimes that your average person just doesn't understand or doesn't even care about, frankly. They want to know, can I pay for the vacation that I'm taking next summer? Can I pay to send my kids to Harvard? Can I pay for a new car next year? Like, people think in time horizons and they don't think in factors and styles. And yet the whole industry and the asset management business is structured around style investing, basically. And when you try to communicate that inside of a financial plan, I think people they have a vague understanding of it, but they don't really understand it. And so when you can talk to people about things in terms of time horizons, it's really valuable because people get it. Like, you wouldn't believe, I was working with somebody, they had an incredibly complex financial plan, and all the wife cared about was the ability to remodel the bathroom next year. It was like the only thing she cared about. She desperately wanted this new bathroom. And when I modeled out the financial plan and I showed her that, hey, we've got a 6-month treasury bill that is perfectly matched to your bathroom remodel next year, it was like the only thing she cared about. And she was like, the biggest smile you've ever seen anyone have was her ability to understand that, hey, I've got an asset that is specifically matched to my ability to remodel the bathroom that I want. And that's how people think. People think in time horizons. And so I think the ability to think about these things in time horizons and resolving this temporal conundrum, as I call it, is hugely valuable.
And I mean, the answer might be treasury bills, but I should ask, one of the big challenges that I hear from a lot of the people who are in this audience is what to do with money that's earmarked at like a 3-year time horizon, right? Because it's 3 is it's that awkward length of time where if it's 6 months or a year, you'd probably just keep it in a savings account, right? If it's 5 to 10 years, you'd have some equity or bond exposure. If it's 3 years.
Yeah, it's really hard. It's I kind of write about this in the context of not just the 3-year time horizon, but also like the 10-year time horizon. To me, that whole like sort of intermediate space, it's a really hard one to navigate because it's not, like if you've got a 20-year time horizon, you come to me, I say, put it in stocks. You got 50 years, maybe you put it all in tech. Maybe you're just crazy aggressive with that stuff. That's easy. That's like the no-brainer to me. And the other one that's a no-brainer is the emergency fund bucket. The 0 to 2-year time horizon, to me, it's kind of like, oh, you're just buying, you actually shouldn't take any risk with that. You by necessity probably need treasury bills or at most like, Vanguard short-term bond fund or something like that. But those intermediate ones are tricky. It's and weirdly, it's that allocation, that intermediate time horizon is the one that roughly corresponds to like the global financial asset portfolio. And it's or something like 60-40 because it's a blended time horizon. You've taken all of the instruments and you've diversified the allocation in such a way that, in what I would call my defined duration methodology, it creates a blended time horizon where it's not long duration like the stock market, but it's also not super short like a T-bill is. And it makes it really hard actually because that sort of like 3 to 10-year time horizon, not only is it hard to predict from a liability and expense perspective, but it's hard to build a portfolio that actually aligns with that, where you're not taking so little risk that you're going to not beat inflation, but you're also hopefully taking enough risk that you're generating an inflation adjusted return, but one that isn't also whipsawing you in the intermediate term, where you're trying to, if you're matching it to like a house down payment, it's sort of like, well, gosh, maybe 60-40 isn't right. What if 60-40 exposes me to the risk of like a 2008 where it falls, 30%, and all of a sudden, when 2008 comes around and house prices are down 10%, and I want to buy the house, my asset allocation is also down 30%. And here I am like double whammy, feeling like I made a huge mistake. So it's a hard one. It requires a little more finesse probably in like the way you're constructing the asset allocation. And I'm kind of a fan of building like multi-asset types of instruments where you're getting maybe a little bit of stock market exposure inside of something like that, but you're still building something that's really safe. But it's hard. It's the hardest time horizon, I think, to navigate.
Yeah, absolutely. Let's talk principle number 9, past performance is not indicative of future returns.
Yeah,
We
so
hear that all the time.
this is in basically every investment document in human existence now. But it's important to understand, I think, in the context of like, I did a lot of back testing in the book. I show a lot of historical performance. And I think that, the part of the things that we need to go into all of this understanding is that the future is not going to look like the past, and it could look very, very different. Like we've gotten used to the United States doing incredibly well relative to foreign stocks, and who knows if that's gonna. It's one of the reasons why I'm a big advocate of global diversification, because I think that the world of the future is just going to look so different, and I don't know if what are the it's interesting, like from a historical perspective, to think about like an investor in the year 1700 who was looking at like something like what I would say the global financial asset portfolio is. Like, what were they investing in? The United States wasn't even a thing back then. And so it's weird to think about, this through a historical lens, because that investor is probably somebody who, let's say they were living in the UK. They're a British investor who probably owns almost exclusively British companies. 200-300 years later, what are all the best performing instruments? They're all just totally different. And so the world is going to look very, very different in, even 10 years, 50. I think the world is changing faster than it ever has. And, especially with AI and the robotics and the sort of, the shifting technological landscape of everything. Yeah, I think it's useful to go into all this with realistic expectations that the future is going to look really different. And I don't know what inflation is going to be. I don't know what the US stock market is going to do relative to emerging markets, or, it was actually one of my favorite portfolios that we didn't talk about was the forward cap portfolio, which is a portfolio that I actually try to extrapolate a lot of the big macroeconomic trends out into the future to sort of skate to where the puck is going. So like the thinking is like, well, if technology is 35% of the S&P 500 today, well, what is the forward capitalization of the technology sector going to be in, say, 50 years? And if I think it's going to be 50%, well, shouldn't I own 50% in my allocation today, kind of skating to where the puck is, knowing that I'll generate higher returns along the way by kind of skating to where the puck is, rather than what a market cap weighted index fund basically does, is it skates with the puck. So it's constantly, which is very effective, obviously, but it's not skating to where the puck potentially is going. And so I tried to kind of extrapolate some of this out, but also with the full admission that, like, I emphasize this a lot in that portfolio, that this thing is high risk, and I'm making a ton of guesses. I'm making a ton of really active guesses about what the forward portfolio is going to look like. And so going into this with realistic expectations, I think is useful, because it adds to the benefit of why you're diversifying your portfolio in the first place. You diversify in large part because we don't know what the future is going to look like.
Right. And the risk of that guesswork is the risk that you're wrong.
Yeah.
Right.
Yeah.
And the risk of missing the thing that takes off.
And accepting the inevitability that you're going to be wrong about certain things at certain times. Like you're going to allocate money to cash or bonds potentially that looks really stupid in years like 2022. And that's just part of how all of this works, is that it's never going to be perfect, which is weirdly like the emphasis of like the book, is that there is no perfect portfolio.
Right. All right. Let's talk about the 10th and final principle, which is to set realistic expectations and stay the course.
Yeah. So this is, again, kind of tying into the number 9, that go into this with realistic expectations, where you're not, deluding yourself into thinking that the stock market is where you're going to become like fantastically wealthy. It's not going to necessarily be the driver of how you get rich. And, I think you have to go into this understanding the way that certain instruments generate certain returns, and build in realistic expectations by understanding things like the real returns, and adjusting for all of these things, where you can go in and you can say, okay, well, I could realistically generate 4 or 5% in aggregate, and over the course of the long run, this will generate, X outcome, and that'll serve me fine. That'll meet my financial needs, and I'll be able to retire and, pay for all of the things that I wanted to consume along the way and whatnot. But you got to go into that with really realistic expectations. Because if you go in with, like, I think these sort of, like expectations that you're going to, generate 10% per year, that you're going to like be the next Warren Buffett. Like I was convinced when I was 20 years old that I was going to be the next Warren Buffett. And after, you know, unfortunately, I invested into the teeth of the NASDAQ bubble implosion for my first, 4 years of investing there. So I got kicked in the you know what's right off the bat, and then got kicked again, just a few years later.
2008, yeah.
But so I had a kind of a hard introduction to portfolio management right off the bat. But I had these diluted expectations also, where I went into all of this thinking that I was going to generate, 20% per year for the rest of my life, because I was convinced that I'm a smart guy, who I have a finance background, and I'm going to beat the market and, have these incredible returns. And then you actually start paying the bills by realizing the returns, and you realize, oh crap, inflation was higher than I expected, and the tax bill was higher than I expected. The fees I paid, the other, sort of intangible costs were higher than I expected. And so you got to go into all this with really realistic expectations. And, and I think those realistic expectations make your portfolio much more viable in the long run, because you won't get derailed when things go haywire and you get frustrated or you get disappointed at times, and because you didn't meet those like sort of unrealistically lofty expectations that you had going into it all.
How do you know if your expectations are too wild?
God, that's a great question. I would say, just go into it with a realistic set of assumptions that you're embedding into the planning process, where if you're assuming that inflation is going to be 1%, you're probably going to be wrong. If you think you're going to do 10% net returns on average throughout your portfolio, you're probably going to be wrong. And so you can set these sort of like probabilistic outcomes based on the assumptions you're embedding. And that's the other hard thing about investing, is that we're all necessarily making, forecasts about the future in sort of explicit or implicit ways. And it requires us to sort of project all of this out in some way. But you want to approach all of that in just I think a super realistic way, where you're using past data to understand the future, but also being realistic about what are the likely outcomes in the future, so that you're not, tripping yourself up before you even, take off.
Thank you for spending this time with us. Where can people find you if they would like to learn more?
My firm is Discipline Funds. Our website's disciplinefunds.com, and I write kind of a bloggy commentary there called Discipline Alerts that people can subscribe to if they want to listen to me ramble on more.
Oh, amazing. Amazing. We'll link to that in the show notes. Thank you.